Stephanie Link, welcome to the program. Boeing, Wells Fargo, you bought those. Why now?
Hi, Scott. Thanks for having me. Both are company specific, and it's based on the action or the negative reaction to the overall market. Boeing is down 12% year to date, so adding to it. It usually trades on the 737 MAX news and 787 production and delivery status, and they're making progress on both. It also trades on free cash flow, which was actually better than expected last quarter at almost $500 million versus a negative $4.3 billion year over year. And that's only going to get better as we reopen. And now I know people, myself included, focus on aerospace and services at 55% of the total revenues. I don't think they're getting much credit for their world-class defense business, which is 45% of total revenues. The Department of Defense is 85% of that, and the book-to-bill is 1.24 times. They have $16 billion in cash, and they just paid down $4 billion in debt. As I mentioned, the cash is going to go higher as we reopen, and you get a catalyst with the China recertification coming in the next couple of months and the 787 production issues getting resolved. So I like this company. I like the fundamentals, and it's down 12%, so I'm buying more. In terms of Wells Fargo, you know I've been on this story for a really long time, but it's down 15% from its highs. It trades at 1.2 times book, 12.7 times earnings. They just raised the dividend. It now yields 2%. The restructuring is making progress. We are seeing results in their guidance. They expect higher NII, net interest income, and better cost guide. And this is the most levered to rates. 50 basis point increase in rates is 16% to earnings. A 75 basis point increase in rates is 8% to net interest income. So you have operating leverage. You'll have better top line. You've got good cost controls, and I think you can see $6 a share in earnings power by 24.
If you think, sorry to interrupt you, if you think rates are actually going to go up. I mean, I was surprised to hear Scott Minerd yesterday on Closing Bell say that he thought we're topping out 2 to 2.25 was where he was looking at for the 10-year. I mean, if we're topping out now and the economy's slowing, that's not necessarily a great environment for the banks. It certainly isn't as pretty a picture as you paint in terms of the earnings power that Wells has.
Well, Wells is a restructuring story. They don't necessarily need higher rates. It will help a lot in terms of getting to that $6 a share in earnings power for sure. But what if the Fed starts to deal with the balance sheet? That will steepen the yield curve, and that will be a positive. So I am in the camp that the Fed does 4 times this year, and then we become data dependent. We're all going to be data dependent. I don't think 4 times or 7 times, for that matter, in terms of raising rates, is going to slow the economy materially.
Okay.
Yeah, we're going to slow, but I don't think we're going to go below trend, not this year anyway.
Steph, I appreciate you calling in. We'll see you back on the show soon. That's Stephanie Link, Hightower.